Moving on, stocks soaring over the past 2 days as investors digest more data showing inflation is moderating. But for some, it's too soon to cheer. This week, CEO of JP Morgan Chase, Jamie Dimon, telling Bloomberg the Fed may need to do more, saying people are overreacting to short-term numbers and they should, in his words, stop doing that. He said inflation, in fact, could prove stickier than we think, and it might not go away that quickly. For reaction, we turn to Ed Yardeni, president of Yardeni Research. Dr. Ed, it's great to see you.
Thank you.
And so, Ed, let me first get your reaction just to Jamie Dimon's comments. Of course, yesterday we had that big, Ed, post-CPI party. Stocks were ripping, but Jamie Dimon coming out, kind of throwing some cold water on there, saying inflation he thinks could be stickier. Maybe there's another hike in the pipeline. What do you make of Dimon's reaction?
I don't know why he's been so pessimistic for so long. I mean, last May, he was talking about a hurricane coming. He was forecasting a recession. Back in May of last year, he was saying that consumers are in good shape now, but they're going to run out of their excess savings and retrench. So he's been really a pessimist on the economy. Now he's being pessimistic also on inflation coming down when the markets have rallied, mostly because, guess what? Inflation is coming down. So I don't know where he's coming from. He's a smart guy for sure. He's certainly much better plugged in than I am in terms of knowing all the loan demands that are out there and what's going on in the economy from sort of the ground level. But from my view up above here, maybe 30,000 feet above, things look pretty good in the U.S. economy. So I don't agree.
Ed, it's Julie here. Similarly, yesterday, the enthusiasm that he was seeing yesterday in the markets, we all saw that enthusiasm, broad-based enthusiasm following the CPI report. PPI seemed to confirm some of that today. It felt like maybe it was a pivot point. Do you view it that way?
Oh, absolutely. Look, I think we've been in a bull market for stocks since October 12th of last year. And we got to my year-end target at 4,600 by July 31st of this year. So way ahead of schedule. And I was one of the optimists. And I thought, well, maybe I'm not optimistic enough, but I concluded we might have a correction. And sure enough, we had a 10% decline in the market from July 31st until October 27th. And now I think that correction is over and the bull market's resuming. And I think we started a Santa Claus rally. So I think there were a lot of shorts. There's a lot of pessimism out there. Jamie Dimon is not the only chronic pessimist. There's plenty of them. But overall, the economy just continues to surprise the naysayers because it's been growing better than expected, with inflation moderating faster than expected.
And Ed, when we talk about the naysayers' consensus, I mean, we have a lot of smart economists and strategists on it. And when they look out to 2024, many think, the Fed is going to stick this soft landing. Of course, consensus 12 months ago, Ed, was, I think you had a lot of people saying we're going to hit a recession. So make a consensus what you want. But what do you see in 2024? Are you predicting a soft landing?
Yeah, well, I started out this year by saying that we're in a recession. I should say 2022. I said we're in a recession. It's just a rolling recession, hitting different industries at different times. And I figured that on balance, the economy would continue to grow. And it's turned out to be even more resilient than I thought. I mean, I didn't expect 4.9% growth in real GDP in the third quarter. Things are simmering down now. They're slowing down somewhat. And I think, there's a lot of people watching the Fed, and a lot of people tend to be very critical of the Fed. It's almost contrary to agree with the Fed. And I've been a contrarian saying, the Fed may actually get it right. Inflation may come down and they may get it without a recession. And so next year, I think we're looking at a 2% growth for real GDP, inflation maybe 2 to 3%. So I'm very optimistic that inflation is going to continue to decline. And in that scenario, the bond yield has peaked, and bonds should kind of hang around here, and stocks are probably going higher. I got 5,400 on the S&P 500 by the end of next year.
That is definitely a loftier target than we've heard from some other folks. I mean, as you say, people love to sort of hate on the Fed and criticize the Fed. And they also love to guess what the Fed is going to do, right? There's what the Fed has told us through its dot plot, what it's going to do next year in terms of cutting rates. And there's what everybody's guessing they're going to do. How do you see that trajectory working out?
Well, again, I've been kind of agreeing with the Fed's view of things. And back, I think it was in June, they changed their numbers for what they're going to do next year. Instead of 4 rate cuts, they're now talking about 2 rate cuts. I think that's a very plausible scenario, and I think the economy has demonstrated that it can handle 4.5% to 5% bond yields, which is what we have, and that's what we had before the great financial crisis. So we're kind of going back to normal, which is kind of refreshing, don't you think?
And Ed, let me ask you, and I'll get you out here on this, for investors who are listening right now, as you look at the U.S. stock market today and looking ahead out into 2024, where do you see opportunity, Ed? What sectors look attractive to you here?
Yeah, well, I've been recommending overweighting technology, financials, and energy. Energy has been sort of a flunker here, but I think it'll make a comeback. I think, the Saudis try to get the price of oil up to $100 a barrel. And I think the market demonstrated that's just not going to happen. China's too weak. Europe's too weak. And so I think 75 to 85 oil is probably what we're going to consolidate. I think that's energy companies that have cut back on capital spending are going to be able to generate lots of earnings and cash flow on that. Financials have been, looked on with some concerns. We had a banking crisis back in March. Then we had some rebound in the financial stocks. Then they came back down during the correction. But if there's not going to be a recession and interest rates are going to stabilize here, I think the financials are going to do just fine. And then technology, we all know the story there. There's a tremendous demand for technology. I think this will wind up to be the roaring 2020s when we look back on it. And it'll be so because companies will use technology to increase productivity, which is a wonderful way to have economic growth with low inflation, real wages going up, and profits being strong.
Ed Yardeni, such a pleasure to see you. Thanks so much for joining us today.
Thank
We
you.
appreciate it.